If you were tasked to manage $1 million, can you guarantee a 50% annual return? There might be creased foreheads and hesitations right now, but there's actually a guy who is up for the challenge with 100% confidence. Any guesses on who it might be? This guy is Warren Buffett, who claimed during a 1999 Businessweek interview that he could achieve 50% annual returns if he only managed $1 million. He also highlighted the advantages of managing smaller sums of money. Curious about how he can make such a bold claim? Stay tuned to find out more. Welcome to Financial Literacy. Here, we are dedicated and passionate about bringing you nothing but honest and straightforward facts about your money. We will help you take control of your finances and get you to the next level. Whether you're a beginner or experienced, this is your one-stop shop for all things financial literacy. If you're already familiar with Warren Buffett, that's awesome. But if you're not, I got you. He's just a very simple guy, just one of the most successful investors of all time. Warren Buffett is nicknamed the Oracle of Omaha. Way back in the 1950s, he had the highest returns. That was when he was managing relatively small sums of money. He believes that managing smaller amounts offers more flexibility and access to investment opportunities that aren't feasible to larger sums. He also runs Berkshire Hathaway, which owns numerous companies such as the insurer Geico, the battery manufacturer Duracell, and the restaurant chain Dairy Queen. Let's explore Buffett's strategies, and who knows, you can apply them to your financial journey. Alright, let's dive into the world of investing with a bit of fun. The first thing we need to pay attention to is small stocks. Yep, those little companies that can sometimes be hidden gems. Think of them as the secret treasures of the stock market. Now, let's talk about the legend himself, Warren Buffett. This guy manages billions of dollars through Berkshire Hathaway, so he has to focus on investing in big companies. Why, you ask? Well, imagine trying to push a huge boulder. If you just give it a tiny nudge, it barely moves. That's what a $500,000 return looks like when you're dealing with billions. It's just a tiny nudge and doesn't really make a big impact. But here's the fun part. If you've got a smaller amount, like $1 million, you can invest in smaller companies where your returns will actually make a noticeable difference. It's like finding a treasure chest. You're definitely going to appreciate those gains. Buffett's advice? Look for small stocks in areas you know well to find those undervalued gems. Before we dive in head first though, we need to understand what we're doing. So, how do we get started? First, pick an area or industry you're interested in and become an expert in it. We can't know everything, right? It's like trying to juggle too many things at once. It's just not practical. Once you've got your area of expertise, check out the stocks in that field. Look for hidden opportunities and the best deals. It's like being on a treasure hunt. Keep your eyes open and you might just find those hidden gems. For the second strategy, we can say that it's a close cousin to our first strategy. We are diving deeper into the world of small cap stocks. But this time, we're zooming in on small companies with US stocks. Yep, it's all about that good old American charm. You see, our buddy Warren Buffett, the Oracle of Omaha himself, has a soft spot for US companies. Why, you ask? Because they're trustworthy and operate under some of the strongest business regulations in the world. Think of it like finding a trustworthy friend in the wild world of dating. Security is key, whether it's in relationships or investments. The US stock market is a well-regulated playground, thanks to the Securities and Exchange Commission. There's a tight leash on financial data, ensuring its reliability. Investing here is like playing on a well-maintained, safe playground where you know the swings won't break mid-ride. Now, let's compare this with investing in small companies in countries with lax regulations. Imagine a playground with rusty swings and wobbly slides. Risky, right? That's what investing in these markets can feel like. Unreliable financial reporting and shaky regulations can lead to some nasty surprises. Yikes! Certainly, a surprise we won't like. In short, focus on small-cap US stocks. They offer the double whammy of potential growth and a safety net provided by stringent regulations. It's like getting the best of both worlds, exciting returns and a solid foundation. I hope you're keeping up, folks. What do you think of the strategy so far? Are they making sense and lighting a bulb in your mind? We'd love to hear your thoughts. Shoot your comments below, and let's spark a conversation. Are you a fan of the thrill that comes with payday and holiday shopping sprees? You know, that magical moment when you spot a red tag signaling a sale, and you can help but dive in to snag those sweet deals at a fraction of the price? Well, guess what? That is exactly the vibe we're channeling with our third investment strategy, buying stocks at bargain prices. Picture this, just like you're hunting for that chic jacket or that latest gadget on sale, we are on the lookout for stocks that are priced below their intrinsic value. It's like finding a treasure chest buried in the clearance aisle, except this treasure has the potential to boost your returns big time. Here's a fun fact for you. Small cap stocks, those scrappy little companies that don't get as much attention as the big players, are like hidden gems in the stock market. These stocks often fly under the radar, meaning fewer analysts are dissecting them. This gives savvy investors like us a golden opportunity to discover undervalued stocks before everyone else catches on. It's like being the first to spot a secret sale. Now, I won't lie to you, this strategy does require some math wizardry. You need to crunch the numbers to figure out the true value of these stocks. But once you do, it's like hitting the jackpot. When you scoop up stocks that are priced way below their intrinsic value, you're setting yourself up for some hefty returns as those stocks climb their way up. So here's the game plan. Instead of just drooling over the big name companies, turn your attention to the small cap stocks. With a bit of number crunching and a keen eye for value, you'll be making smart investments that can lead to some serious gains. Just like snagging that perfect item on sale, you'll be getting more bang for your buck. And the only direction left is up, and up. Isn't that amazing? We all know how our feelings can sometimes take us on a wild roller coaster ride, right? They say you shouldn't shop or make decisions when you're emotional. And that is our fourth strategy. And it is a golden ticket when it comes to investing in stocks. Managing your emotions is crucial. Picture this. You're an investor who stands firm and doesn't let the crowd sway your decisions. What does that mean? Well, it's like not freaking out when everyone else is. Imagine stock prices are dropping and everyone around you is panicking and selling their stocks. In our world, that's actually a golden opportunity to buy more. Yep, you heard me right. When the masses are gripped by fear and panic, stay cool, calm, and collected, and buy those undervalued stocks. On the flip side, when everyone's buying like there's no tomorrow because stock prices are soaring, you should chill out. There's a historical example to back this up. The Facebook stock dropped in 2018. The best time to buy was when others were fearful. The main point here is to keep your emotions in check and buy during market downturns to capitalize on undervalued stocks. It's all about maintaining stable emotions and seeing the opportunities when others are too blinded by panic. So, keep your cool, make smart moves, and let's get those returns. Last but definitely not least, keep searching and learning. The more stocks you analyze and the more rocks you turn over, the better your chances of finding those hidden gems that others might miss. Peter Lynch, a legendary investor, once said that the more companies you research, the higher your chances of finding good investments. Take a leaf from Warren Buffett's book. His daily routine includes reading financial manuals and analyzing businesses, a practice that has greatly contributed to his success. So don't shy away from doing your homework. Dive into research, read up on companies, and dig deep into financial reports. Who knows? Those golden opportunities might be just a few miles away, buried beneath the surface, waiting for you to uncover them. The key is persistence and dedication. Keep at it, and you will increase your chances of finding valuable investments. To sum it all up, achieving a whopping 50% return on a cool $1 million is totally possible. And it's all about strategy. Think of it as a treasure hunt where flexibility is your secret weapon, allowing you to pounce on those high return opportunities. Dive into smaller, under-the-radar stocks, focus on trustworthy US companies, and snag those bargains below intrinsic value. Keep your cool when everyone else is freaking out. Buy when the market's having a meltdown. Most importantly, channel your inner detective and do your homework. As investing legends Buffett and Peter Lynch remind us, thorough research and diligence are your keys to striking gold. Ready to turn your investment game into a thrilling adventure? Let's go! We are looking forward to hearing your success stories. Thank you so much for watching. If you're craving more content about financial literacy, don't forget to like, share, and subscribe to this channel. Stay tuned for more. See you in our next video.